Hello students, myself is Parminder Singh from Prab Kripa classes. Our today's topic is understanding current account in balance of payments. We have already learnt in our earlier courses what is the meaning of balance of payments. We have also learnt that there are three components of balance of payments, that is current account, capital account and financial account. We have also learnt about the error and omission element which is present there in the balance of payments record. We have also learnt what are the reasons for disequilibrium in balance of payment and what steps can be taken by the country to improve its balance of payments position. We have also learned that the balance of payments can take three situations such as balanced balance of payment, surplus balance of payment situation or deficit balance of payment situation. Now, in this course, we will learn the meaning of current account. We will understand that it is one of the main components of balance of payments. We will also understand that the essential ingredients of current account are visible items, invisible items, unilateral transfers and income. We will also understand that to calculate current account balance, we can make the total of the entries which appear on the credit side and which appear on the debit side, and we will deduct current payments from the current receipts. You will learn all in detail with the help of practical examples. Then you will also understand that what is the meaning of surplus current account. Surplus current account may indicate that the country is net exporter. Deficit current account may indicate that the country is net importer, and some other indications also will be discussed in detail. We will also understand that there can be three situations in respect of current account, that is balance current account, surplus current account or deficit current account. You will find this course in a very simple manner. You will understand it fully. Thanks. Now the topic before us is current account in balance of payments. We have already learned that there are three components of balance of payments. First is current account, then capital account and financial account. So current account is one of the components of balance of payments. Every country has to make exports or imports with the rest of the country. Suppose this is our country and this is the rest of the world. So we have to export goods. We export goods which we have in abundance. We also import goods from the rest of the country, rest of the world. In the same way, we also provide services to the rest of the world, that is export of services. In the same way, a country may also receive services from the rest of the world, that is import of services. Sometimes we get humanitarian aid from other rest of the world. For example, there may be some severe earthquake when we receive foreign aid, or there may be some sort of grants, or the individuals of residents of the country may receive gifts from their relatives abroad. So a country may receive unilateral transfers. When we are receiving unilateral transfers, that is the one time transfers from the rest of the world, There are also times when we send aid to the rest of the world, or the gifts are sent by individual residents of our country to the rest of the world. So unilateral transfers are paid. These are unilateral transfers which have been received. Sometimes we receive income for our investments made abroad in the form of rent, interest, or dividend or profits. That is, we receive income from investments abroad. Sometimes there are occasions that usually there are some investors have made investments in our country. So the payment has to be made to them. So income paid for investments held domestically by the investors of abroad. So we have to make payments for investments, income in the shape of profit, dividend, or incentives which is paid abroad. So you can find that all these transactions, whether these are export and import of goods and services or unilateral transfers or income for investment either received or paid, come within the purview of current account. This is the current account. If I straightforwardly define what is current account, you may or may not understand the same. So I hope you have understood what is the current account. Current account is the account in which we make record of transactions pertaining to export and import of goods and services in respect of unilateral transfers paid or received, or income from investments paid or payments made abroad in respect of the investments held by the foreign investors in our country. So it is one, current account is one of the primary components of balance of payments. As already told, other components are capital account and financial account. There is, in case of balance of payments, there is also one additional element which is known as error and omission. Current account records all the transactions related to export and import of goods and services, income earned from foreign investments, and payments made to foreign investors, and unilateral transfers sent abroad and received from abroad. I hope the definition of current account is now clear to you. So all these transactions which take place between a country or the residents of a country and the rest of the world during a given period, which is usually 1 year. A country's current account balance can be influenced by a variety of factors such as its economic growth, trade policies, exchange rate, international competitiveness. It means that whether the country is importing much or exporting much, or whether it is receiving less income and giving out more income, it all depends on the trade policies, exchange rate, international competitiveness, and economic growth. Now, this is the current account. In balance of payments, a brief overview of the same. Here, in case of balance of payments, the entries have to be recorded in the form of debit and credit items. Here, outflow means outflow of foreign exchange. All the transactions due to which there is outflow of foreign exchange are recorded on the debit side, and all the transactions on account of which there is inflow of foreign exchange are recorded on the credit side. You will see that if we export goods and services, there is inflow of foreign exchange. If we import goods and services, we have to make payment abroad, so there is outflow of foreign exchange. When we receive unilateral transfers from abroad, there is inflow of foreign exchange, so it is recorded on the credit side. When we make unilateral payments, transfers abroad, when we send payments abroad in the form of one time transfers, then there is outflow of foreign exchange. When we receive income for the investments held abroad in the form of dividend, rent, profits, then it is recorded on the credit side because it is inflow of foreign exchange. When the payment is made abroad to foreign investors for their investments held domestically in the form of dividend, rent, interest, then these are recorded on the debit side. This is the broad overview of the current account. Now the topic before us is the building blocks of current account in balance of payments. There are four components of current account in balance of payments, and these are visible items, invisible items, unilateral transfers, and income. We will discuss each of these one by one. First is visible items. What is meant by visible items? Visible items means those things or goods which can be seen and touched. For example, rice, wheat, oil, computers, or all other such items which can be seen. Here, as you already know that this is the form of current account. On one side there is debit and on the other side there is credit. Debit is minus and credit is positive. So here under this head, under the visible heads, visible items, we record export and import of goods. Visible items. Here we record export and import of goods. When we export goods, what happens? When we export goods, we receive foreign exchange. So it is recorded on the credit side, export of goods. When we import goods, what happens? There is inflow of foreign exchange. So these are recorded on the debit side, import of goods. So these are the visible items. That is visible items as already discussed, which can be seen or touched. Further, next point, invisible items. What are the invisible items? Invisible items are those which cannot be seen or touched. The examples of invisible items are transport services. Invisible items are services. The examples of services are banking, insurance, shipping, transportation, etc. The services cannot be seen or touched. Under this head, we record all the transactions related to the export and import of services. This is the current account as already told. Here, we after that invisible item, visible items we record transactions related to invisible items. When we export services, what happens? Foreign exchange comes in. So these are recorded on export of services. Foreign exchange comes in. So these are recorded on credit side. When invisible items such as services, banking, insurance, services are received from the other countries, what happens? When we import services, what happens? Foreign exchange goes out. So invisible items are recorded on import of invisible items are recorded on debit side, import of services. Then unilateral transfers. Unilateral transfers are one-time transfers. They are also known as unrequited transfers. Unrequited transfers. Why? Because these transfers are made without the expectation of getting anything in return. These transfers are no quid pro quo. It means quid pro quo means something for something. That is, if we give something to anyone, we get something in return. But these unilateral transfers are no quid pro quo. That is, we do not get anything in return. For example, at if there is a natural disaster in any country, we may send them aid in the form of food, medicines, or even in the form of money. So these are unilateral transfers. It may also happen that some of our residents are living abroad and money they send money to their family members in the home country. So these types of transfers are known as unilateral transfers. In the same way, some of the foreigners may be working in our country. They may be sending their money to their families which are residing abroad. So here, under the head unilateral transfers, we take into account all the unilateral transfers which are paid by us abroad or which are received from abroad. How these are entered? These are the visible items, these were invisible, and then comes unilateral transfers. If we make payments of unilateral transfers paid. When we pay, foreign exchange goes out. There is outflow of foreign exchange. So these are recorded on debit side. When we receive unilateral transfers, foreign exchange or money comes in. So unilateral transfers received. It may also happen that sometimes a country may give debt forgiveness. That is, if a country has given loan to some outer world, to any country in the world, and due to certain reasons, it has forgiven the debt as a whole, or it has given its right to take back the debt, then it is called debt forgiveness. Debt forgiveness is also comes under the definition of unilateral transfers. These are also to be taken into account under the head unilateral transfers. Then there comes income. It happens that we may have made investments abroad, that as a country or as individuals we may be having some investments abroad. In the same way, foreign investors might be having some investments domestically. In our country, they might be having made some investments. So when we are having investments abroad, we may be getting some income in the form of rent, dividend, or profits. In the same way, if foreign investors have invested in our country, they may be receiving or they will be getting from our country income in the form of rent, dividends, and profits. So, this is the fourth point, which comes under the head debit and credit. Income. If we receive income, then there is inflow of foreign exchange. So, income from investments held abroad, it is taken on the credit side because we are getting foreign exchange. Income is coming into our country. So when we make payments made abroad for investments held domestically means they have made foreign investors have made investments in our country, and now they are getting rent, dividend, profit, etc. from our country. So we have to, in other words, we have to make payments to them. So foreign exchange will go out of our country. So in this way, these are the four components, that is export and import of goods, export and import of services or invisible items, unilateral transfers paid or received, income received from abroad, or payments made to invest foreign investors or investors abroad. Hope you have understood the components of current account very clearly. The topic before us is calculating the current account balance in the balance of payments. We will understand how to calculate the current account balance in the balance of payments. We will understand the same with the help of an example. Firstly, we will form the current account. As you know that current account has two sides. One is debit side. It represents negative figures because it represents the outflow of foreign exchange. Then the other side is credit. It represents positive because there is it is these transactions on the credit side result into the inflow of foreign exchange. It is current account. We are forming current account in balance of payments. Every country does some export of goods, those goods which it may be having in abundance. So when it exports goods, what happens? There is inflow of foreign exchange. So we record it on the credit side, export of goods. On the other hand, suppose we are an oil rich country and we do not have wheat grains. So we may be importing wheat. from the other country or the rest of the world. So what will happen if we import something? There is outflow of foreign exchange. So these are recorded on debit side. Sometimes we as a country provide certain services to the rest of the world, such as banking, shipping, transportation, insurance. So if we export services, what happens? There is inflow of foreign exchange. So when there is inflow, these are to be recorded on the credit side. Export of services. We can also call goods as visible items, or services may be also known as invisible items, because services cannot be seen or touched, whereas on the other hand goods can be seen, touched and measured. So these are called visible items, goods are called visible items. So in the same way, we may also require or avail the services from the rest of the world, certain services such as shipping, transportation, banking, insurance. So what happens if we import services? If we take the services from the rest of the world, then we have to make payment. There is outflow of foreign exchange. So here, import of services. When we will prepare this current account, and after that we will see how current account balance is calculated. Now at times we make unilateral transfers, that is one time transfers, that is unrequited transfers, for which no services or money is expected in return, such as we may send food or medicines or money to other countries on humanitarian ground. Sometimes the residents of our country may receive personal gifts from their relatives living abroad. There may be also, it may also happen that some persons who are the residents of this country but working in a foreign country may send remittances to their families living in this thing, living in our country. So these are also unilateral transfers. So when we receive unilateral transfers, what happens? There is inflow of foreign exchange. Unilateral transfers received. In the same way, sometimes there may be need, or we may think that we should also provide aid to the rest of the world or certain countries on humanitarian ground, or some of our residents may send personal gifts, or the persons who are working here but belong to foreign countries may send remittances to their families living in the foreign countries. So when unilateral transfers are there which are sent abroad, unilateral transfers paid, it result into outflow of foreign exchange. Then it may also happen that we have made investments in foreign countries, and due to our investments abroad we are getting dividend, interest, rent, etc. So when we are receiving income from investments abroad, what happens? There is inflow of foreign exchange. So when there is inflow, it is to be recorded on the credit side. Income for investments abroad. When we receive income, it is to be recorded on the credit side of the current account. When It may also happen that some foreigners may have made investments in our country. They will be getting income in the shape of interest, rent, or dividend, etc. So, income or payments made abroad for their investments domestically. Domestically means they are having investments in our country and due to which they are getting income. So these are the components of current account. Now we will come how current account balance is calculated. Suppose we are exporting goods worth say 6,000 US dollar. We are making exports, and on the other hand we are importing goods say worth rupees $5,000. We are exporting services say 200 US dollar. We are not mentioning the figures in crores or millions or billions so that we may only to keep the example simple and so that we may mainly understand how the current account balance is calculated. So we may also import services from the rest of the world. So their value we may write it as say 200. It is also in US dollars. So it may happen that we are receiving say unilateral transfers from abroad say to the tune of 1000 US dollars, and we are making payments to them. We are making payments for unilateral transfers to the rest of the world say to the tune of 2000 US dollars. In the same way we are getting income say for only 1100, and we are only now getting payments from we are making payments abroad say for 200. So now what we have done, we have mentioned values, hypothetical examples we have taken. We take it as 200, 100, 1000 or 2000. We take it as this one. Why we have made this amendment? It needs to be clarified that in the current account most of the figures are reflected here, import and export. And the second major item which appears in the current account is income, and unilateral transfers normally take the third figure, that is it is the least in the current account, so I have reduced in this question also. So what happens now, we will total the debit side and total of credit side. What is the total of debit side? It is 7,400, 5,000, 2,000, 7,000, 200, 200, 7,400. Now we will come to the credit side. 6,000, 7,000, and this is 7,300. So what has happened? You can see that outflow of foreign exchange is more, inflow is less. So what is the result? Net balance. When we are to calculate net balance, we will take credit first, credit minus debit, that is 7,300 minus 7,400. What is the net result? Net result is minus $100. This is the net balance in current account. If we take debit side first, then what is should be the formula? Minus debit, फिर then again there will be minus credit. So when we will open, what happens? Minus debit will be minus 7,400. When we will remove the brackets, the credit will become positive. So again it is minus $100. So you are to take this point into consideration, or this is the formula for calculation of the net balance in current account. We can also take it otherwise. How? What is the other formula? That we take each item separately and we calculate balance at the end. Balance of visible items, balance of invisible items, balance of unilateral transfers, balance of incomes. Then we can calculate here at the last what is the balance, and at the last we will do the total. So this is the another formula. We have calculated this, that we have credited, we have totaled the, we have summed up the credit items, we have summed up all the transactions which are on the credit side, and we have summed the, or made the total of all the transactions which are appearing on the debit side, that is credit minus debit, and we have arrived at balance. Now this is the another formula which can be used: balance of visible trade, balance of invisible trade, net unilateral transfers, net income from abroad. That is, here we will be calculating balance at the last, and here you can see that what is balance. You can write here debit, credit minus debit, whatever it is, positive or negative, you will arrive at the same decision, that is minus $100 in this question. This is the, we have here used the abbreviations: balance of visible trade, balance of invisible trade, net unilateral transfers, net income from abroad. What it means? If we are talking about balance of visible trade, it means the difference between the export of goods and import of goods. When we are talking about balance of invisible trade, it means the difference between export and import of services. When we are talking about net unilateral transfers, it means the difference between unilateral transfers made or unilateral transfers received and unilateral transfers paid. And in the same way, income paid and income received and income paid, these are written here. Here we have also given examples of net unilateral transfers, that is foreign aid, donations, worker remittance, gifts. We have here given the examples of net income from abroad, dividend, interest, profit. We hope you have understood in very clear terms how we arrive at the balance in current account. The current account balance may be either totally balanced, or it may be surplus, or it may be deficit. That is, outflow may be equal to inflow, or outflow may be more or less than inflow. That is, either things may be possible. There are three situations in the case of current account balance. We will also learn about the same in detail later on. Now the topic before us is dissecting the long-term implications of current account surpluses and deficits within the balance of payments. We have here formed a table of surplus current account. As you are aware that every country may export certain goods and services and provide the same to the rest of the world, and the said country may also get certain goods and services from the rest of the world. So there is export and import of goods and services between a country and the rest of the world. So we have here taken the hypothetical figures with regard to export and import of goods and services of a country. In the same way, we as a country may have to make some one-time transfers so that we may help the other countries who are in need, say due to some natural disaster. On humanitarian ground, we may provide some aid to the rest of the world. In the same way, we may receive aid from the rest of the world. We may also receive, that is, the individual residents of our country may receive gifts from the rest of the world, and in the same way our residents may be paying certain gifts to the rest of the world. So all these are unilateral transfers. That is, either unilateral transfers are received, and there are certain occasions when unilateral transfers are paid. So here we have also taken the hypothetical figures with regard to unilateral transfers made and unilateral transfers received. In the same way, we may be having some investments abroad for which our country, or we may be receiving some income from our investments in the shape of dividend, interest, or such like other payments. In the same way, some foreigners might have invested in our country and they may be getting payments for their investments in the form of dividend, profit, and interest. And we have also taken it on a hypothetical figure. So, this is the surplus current account. Why it is surplus? As you know that in the current account or in the balance of payment account, we have to keep transactions as debit side and as credit side. All the transactions which result into inflow of foreign exchange are recorded on credit side, and all the transactions which result into outflow of foreign exchange are recorded on the debit side. So now what we observe from these figures, that total of exports, what is the total of exports? It is 6,100. This is export. What is import? It is 5,000 plus 200, 5,200 import. So what we observe from these figures, that exports are more than imports. Overall, when we do the total of debit and credit transactions, all these transactions, we observe that as a whole, the country is receiving 8,200 US dollars as inflow of foreign exchange due to all these transactions, export, unilateral transfers, and income. And on the other side, the country is making payments abroad, that is there is outflow of foreign exchange to the tune of 7,300, that is current receipts are more than payments. Receipts are more, that is 8,200 is more than 7,300. So what is the balance? Balance is balance in current account is 8,200 minus 7,300. So 900 is the balance. That is, it is a surplus current account. That is, inflow is more to the tune of 900. So it is a current account balance which is positive. It is a surplus current account. What we observe from this surplus current account? What does it indicate? It indicates that the country is net exporter because exports are more. It is a net exporter. It is a competitive economy because when we do exports, there are other countries in the world also who may be exporting the same goods. Suppose we are exporting rice, there may be also many countries in the world who may be ready or who may be doing the export of rice, but we are able to do this export to the tune of 6,100 or 6,000 if we talk about only rice, because our exports are competitive. We are selling at competitive price in the international market. So what is the net result? That surplus current account indicates that the country is net exporter. The economy is competitive. What other figures it may show? It may show that surplus current account may show that we are receiving more income from investments held abroad than the payments we are making to abroad for their investments held domestically. So now surplus current account indicates that on the whole the country is a net exporter. It is exporting more than it imports. It is strong and competitive economy. It is receiving more income from abroad, and surplus current account also indicates that the country is a net creditor. How a net creditor? You have seen that here the figures of credit are more and the figures in debit side are less. So what it means? That the country is a net creditor to the rest of the world in terms of its current account transactions. The surplus typically means generally indicates accumulation of foreign currency reserves. When we are receiving more foreign exchange than the foreign exchange which is being paid, foreign exchange received is more as compared to the foreign exchange which is going out. So it means it may generally lead to accumulation of foreign currency reserves which can be used by our country for stabilizing the exchange rate. Stabilizing the exchange rate, investing abroad, and managing debt. It is possible that any specific component of current account may have individual deficits. What it means? But overall credit side is more than debit side. You have seen that here credit side in total is more than debit side, but individual item may be less. Here you can see that although overall the exports are more, overall the exports of goods and services are more than the import as a whole, but here the export of services is less than import. Import is more. Import of services is 200, whereas export of services is 100. So it is quite possible that an individual item in the current account may be in deficit, but overall, as a whole, credit is more than debit. While a surplus can be seen as a positive indicator, it is not always ideal position. A large and persistent surplus can sometimes lead to deflation, currency appreciation, and hinder domestic economic growth. Now we come to the another point, deficit current account. What it means? It means that we are there is outflow of foreign exchange is more, outflow of foreign exchange is more, whereas we are receiving less foreign exchange due to export and import, unilateral transfers, and income. In the shape of all these transactions, we are receiving less as compared to what we are giving out. From here the given figures, you can see that here the credit items are less. Here debit is debit is more than credit. In other words, outflow of foreign exchange is more than inflow of foreign exchange. So what this deficit current account shows? It shows, here we have filled the hypothetical figures so that you may understand what is the meaning of deficit current account. So here what is the balance in this current account? How it is reflected that it is a deficit current account? Credit minus debit. What happens? Or we can say that receipts minus payments. 6,400 minus 8,200. What is balance? This is balance minus minus 1,800 US dollars. This is the balance. So here the figure is being reflected as minus. It shows deficit current account. Now what this deficit current account shows? This shows that the country is net importer. That is, it is importing more in comparison to its exports. It also shows that the country is a poor or a developing country. It also shows that the country is receiving less income for investments held abroad in comparison to the payments which it has to made abroad for investments held by foreign investors domestically. Now this deficit current account as a whole also shows that the country is a net debtor. Here you have seen that debit entries are more. So here the deficit current account indicates that the country is a net debtor to the rest of the world in terms of its current account transactions. Now, when there is deficit, that is outflow is more. How it will be met out by the government of the country? So the deficit generally leads to increased reliance on foreign borrowing. So more loans have to be taken from foreigners, and difficulty and there is difficulty in managing external debt burden. it is possible that any specific component of current account may have individual credit, but overall debit is more than credit side. But it means that as a whole, imports are more in comparison to exports. Or if we go through all the items on the debit side or credit side, as a whole, debit is more than credit as a whole. But there may be some individual items where credit is more. Here you can see that credit is more in respect of services, whereas debit side import of services is less. So as a whole, debit current payments are more in comparison to receipts. But there may be some individual items also, or single item or two items, where there may be credit side more. A large and persistent deficit in current account can sometimes lead to currency depreciation, inflation, continuous rise in external debt, when we have to make more and more payments outside, so that as our imports are more and we have to make payments, our exports are less, so we may have to resort to external debt. It may continuously rise, and a large and persistent deficit in current account may also lead to lower economic growth, as limited resources are available for domestic investment, as no money is left for making investments in infrastructure, education, and technology. Now, the topic before us is exploring current account equilibrium and imbalance. Three situations may arise in respect of current account. Either the current account may be balanced, surplus, or deficit. To understand this concept, let us have a brief overview of current account. In the case of current account, we are forming a table to understand what is current account. Now, the transactions in the case of current account are recorded on either debit side or on credit side. This is a current account. Here debit entries are in negative, credit side is taken as positive. Minus means outflow of foreign exchange, and credit means inflow of foreign exchange. When we export goods, what happens? Foreign exchange comes, so they are taken on credit side. When we import goods, what happens? Foreign exchange goes out. When we export services such as banking, insurance, transportation, shipping, what happens? Foreign exchange comes in. When we import services, what happens? Foreign exchange goes out. Then there are certain unilateral transfers, one-time transfer. What happens? In the case of unilateral transfers such as aid on humanitarian ground, we may sending to the rest of the world in the form of money, food, or medicines. Then foreign exchange goes out. Unilateral transfers paid. On the other hand, if we receive unilateral transfers received, what happens when we receive unilateral transfers such as foreign aid, donations, gifts? Foreign exchange comes into our country. Then we may be receiving income for our investments made abroad in the form of dividend income. So when we receive income, it is to be on credit side. Income for investments abroad. In the same way, foreign investors may be having investments in our country and we have to make payment, or the payment is made in respect of rent, dividend, so the payment goes out. Income or payments made to investors for their investments held domestically. So when we have briefly understood what is the meaning of current account, these are the entries which are there in the current account. A value of each of these is recorded. In the case of free transfer, such as free food or free medicines are sent to other countries on humanitarian ground, an estimation of the same is made and recorded in the current account. So here total of the debit and credit is made. That is, each whether what is the value of imports of goods, what is the value of import of services, the total of the same is made. Here comes current payments. Here the total comes current receipts. That is, it means inflow, total inflow. Or here comes total outflow. We make the total of debit side and credit side. And when in the case of balance current account, it means that debit is equal to credit or outflow is equal to inflow of foreign exchange. Or in other words, we can say that in the case of balanced current account, the total of export of goods and services and other incoming payments is more than the import of goods and services and other payments made. That is, here we are talking about the value of, that is the value of export and income received is more. Income received is equal to, here we are talking about balanced. Here the value of exports and income received is equal to the import of goods and services and other payments made. It is not that it is exactly equal, that the debit side should be exactly equal. We understand with this help of an example. It can be, say, 100 is equal to 100, or if say it is 101 and on the other hand credit side is 100, it is also okay. There may be some minor adjustment. If debit side is somewhat more, it will also serve the purpose. Or if say it is less, debit side is less, then it is also regarded as balanced current account. It is not that 1:1 equation has to be there. In the case of balanced current account, there may be some minor negative or positive figure. That is, the credit side may be some minor figure more or some minor figure in negative, positive or negative. Either debit may be somewhat more or credit side may be somewhat more, but overall it reflects that they are equal. So here you will see that this is the complete balanced, but here it is also to be regarded as a balanced position. Then we talk about surplus current account. In the case of surplus current account, it means that here receipts are more as compared to payments, or we can say that inflow of foreign exchange is more than outflow. Or we can also say that surplus current account means when the total value of export of goods and services and incoming payments is more as compared to the total value of imports and payments made. For example, if say current receipts are 100 and current payments are 80, so here you can see that credit side is more. Here credit is more than debit, so it is the surplus current account situation. Then comes deficit current account situation. Deficit current account situation comes when debit is more than credit, that is outflow of foreign exchange is more than inflow of foreign exchange, or current payments are more than current receipts, or we can also say that it is a situation in current account when total of total value of import of goods and services and other payments, outgoing payments, is more than the total value of exports and other incoming payments. I hope you have understood this concept easily. That is, it is nothing more. Here debt only, we are to take into account the two sides, whether debit side is equal to credit, debit is more or debit is less. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.